This past month has definitely been weird for the market. It seems that most stocks have been down at least a bit, but some stocks have seemingly been destroyed. Surprisingly, some of these stocks have been some prominent dividend payers, and for shareholders, this can definitely be a bit of a worry. However, on the opposite side of this same coin, this has also created some good buying opportunities for people to load up on some cheap stocks and to add income and hopefully see good long-term appreciation. That is why in this video, I'm going to be discussing 3 undervalued dividend stocks that are looking super attractive at current prices that I think you should buy right now. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. The first stock on this list is a bank, and it is Bank of America, ticker BAC. This stock is one of the most notable in the entire market for many reasons. It is one of the biggest banks in the world, is famously one of Warren Buffett's largest positions, and pays a sizable dividend at around 3.7%. The stock is currently trading at $26.07, which puts it at a P ratio of under 8. To put this into perspective, this stock is cheaper than it was 5 years ago and is down nearly 50% since the post-COVID high and down 23% just this year. In the last 5 years or so, the PE has hit a high of 16.58 and the stock has had a PE ratio of well over 10 for the majority of recent history. This means at current stock prices, as well as the current PE multiple, the stock looks quite cheap. This drop in prices also pushed the dividend up, meaning for dividend-oriented investors, the starting yield of over 3.5% is pretty respectable. Comparing Bank of America to other banks as well puts into picture how cheap this stock might actually be. When compared to similar stocks such as JP Morgan and Wells Fargo, Bank of America has a lower PE ratio. In fact, Bank of America has a lower PE ratio currently than US Bank Corp, which has been significantly hit this year as well. Fears surrounding this bank have been high since the financial issues earlier this year, but I do not think they are fully justified. It is true that this company is not as resilient as stocks like JP Morgan, but it definitely has some good things going for it that prove that this current price to be simply too low. Firstly, Bank of America has some serious market share. They are no longer the biggest bank in the US, but they are still second by a pretty healthy margin with just under 14% of the market. This gives them a huge customer base in which they're able to consistently profit off of due to interest and other financial services. Secondly, Bank of America has a great brand. It is pretty obvious, but it's pretty hard to beat the name Bank of America. The stock is infamous and almost every American is familiar with the company. Because of this, they have good brand loyalty with many of their consumers, and it's also worth noting that switching banks can be a hassle, so most of Bank of America's consumer base is unlikely to switch off of them anytime soon. Lastly, Bank of America has some pretty big backers. The company currently has an institutional ownership of just under 70%, which is decent, but obviously Warren Buffett is a big advocate for the stock as well, prioritizing it even over JP Morgan and Goldman Sachs as he has sold those stocks in the past few years but hasn't touched Bank of America. Warren Buffett's cost basis of Bank of America stock is also just over 1% current trading prices, which means if you believe in Berkshire Hathaway's decision making, this stock looks like a no-brainer buy. So really quickly, let's just round this off by looking at the dividend. This stock, as I said, currently yields just above 3.5%, which is pretty respectable. It has a 5-year dividend CAGR of 12%, but it has slowed in recent years, with the most recent jump being just around 5%. The stock has a pretty good track record though, as it has consistently increased payments since 2013, and the only reason it has only increased payments since then is because it took time to recuperate after the 2008 financial crisis. Overall, at current prices, I'd say Bank of America is looking pretty good. The second stock on this list is a stock I keep talking about, the Coca-Cola company, ticker KO. This company, like Bank of America, is one of Warren Buffett's favorites, and it has also been beaten down in the past few months. The current drop in price has brought it to its 52-week low and means it is down nearly 20% from its peak, which for Coca-Cola is a ton. This has brought the PE ratio down to the 21s, which for Coca-Cola is extremely low. Although it may not seem very low for a company this mature, Coca-Cola has always traded at a premium, making this current PE attractive for the stock. This, like Bank of America, has also bolstered the starting dividend yield to well in the 3% range, making it far more than the market average. Now, the reason Coca-Cola has been doing so poorly this year, outside of just high interest rates, is because of something you probably wouldn't expect. Coca-Cola had one of its worst days just a few days back because of Ozempic. This is after a report that said Ozempic users are cutting back on unhealthy foods and calories in general. This heavily hurts stocks like Pepsi, Coke, and Hershey because they obviously sell snacks that are on the unhealthier side. In addition, because you can get some pretty good CDs currently due to high interest rates, many Coca-Cola investors who are only there for the dividends see CDs as a better alternative, leading them to sell the stock. However, do not let these short-term headwinds convince you out of buying this stock. Coca-Cola is and will be one of the best businesses money can buy. The company has a tremendously strong brand portfolio, with many drinks being extremely recognizable to consumers. They are also a dividend king with over 60 years of consecutive payments, and the dividend is still growing. The payout ratio of Coca-Cola stock is also under 60%, meaning there is ample room for the dividend to grow, and growth is almost guaranteed because of their dividend king status, even if it is on the lower end. The growth of the stock's dividend over the last 10 years has been at an average of 5.21%, and the most recent increase was a hike of 4.65%, meaning it is pretty consistently around the 5% mark. Coca-Cola also, because of their good brands, has great pricing power that they've been able to flex in the past, increasing the price of their drinks but retaining customer support throughout. In addition, their acquisitions in recent years have already been trending towards healthier appeal. They have acquired Body Armor as well as Fairlife in recent years. Both of these acquisitions are clearly targeting a different demographic than traditional Coca-Cola soda, so even if you are super worried about consumer trends shifting, Coca-Cola is and already has been ahead of it. Overall, out of all the stocks I'm talking about today, this is the one I want you to take the longest look at because I really think it is a great buying opportunity. The last stock in this video is NextEra Energy, ticker NEE. This stock has been beaten down huge this year, more than the other two stocks I've talked about already. Year to date, they are down 40%, and since all-time highs, they are down over 45%. This recent drop has pushed the stock price to levels not seen since COVID. If you didn't know, NextEra Energy is a utilities company, and it is the largest one by market cap. They have roughly 58 gigawatts of generating capacity and distributed all throughout North America, specifically the US and Canada. They are well known for their renewable energy alternatives, mainly their big investments into solar farms. The reason the company has done so poorly is for a variety of reasons, but one that I think isn't super important is the fact that many market analysts have slashed price predictions, citing that it's unlikely that they'll be able to keep up with their dividend goals. One of the other reasons NEE isn't doing very well is because although it is already quote-unquote going green, it's definitely not cheap and is costing utility companies billions as they attempt to make the switch from fossil fuels to more green alternatives. This has caused NextEra to build up large amounts of debt while trying to fund this project, which isn't good. In addition, high interest rates makes borrowing money extremely expensive, and it has resulted in NEE struggling to expand. This is particularly bad because NextEra has no choice. In order to keep funding their dividend growth, and company expansion, they have to issue new debt, which will put strain on the company. The truth is, although green energy will be the future and is the best option, it isn't cheap and is putting pressure on companies like NEE to keep their operating expenses low. In addition, because interest is so high, people see CDs as better alternatives than dividend stocks, which is the same issue plaguing Coca-Cola and Bank of America right now. However, although these issues are prominent, I still believe that this company is a good long-term choice. More and more of the energy in this world will become electric, which will increase the need for electricity production, especially in a way that many consumers consider green. Emerging markets as well will need more electricity as time goes on, so utility stocks could look internationally to increase their reach and profits. Also, because of this recent price drop, the dividend is nearing 4%, which is historically good for the stock, especially if they are able to keep up good dividend growth, even if it's worse than what they have been expecting. That being said, their 10-year dividend CAGR is over 10%, and so was their most recent hike, which is extremely impressive. Long term though, I think this company will be a pretty decent holding, especially if they are able to work on their debt, and also if you're able to pick it up at below the $50 range, I think it could be a very interesting long-term position. Ultimately, all three of these stocks are at good valuations currently, definitely better than they have been, and they all provide for an attractive buying opportunity. I think I might pick up some shares of Coca-Cola because as long as it trades at this price, it is extremely hard to pass up. That being said, Bank of America and NextEra also look like pretty good deals at current levels. Anyways, thank you guys for watching this video. I'm sorry this took a while to get out. I've been a bit busy recently with other things like school. That being said, if you liked my picks, let me know in the comments below, but if you didn't, let me know as well. Leave a like and subscribe if you haven't already. Each button you press makes my life just a little bit better. See you all in the next video. Goodbye.